Hello there, viewers at home. Tonight we're diving into the thrilling world of international finance, specifically something called a letter of guarantee, or LG for short. Now, I know what you're thinking. John, this sounds about as exciting as watching paint dry. But trust me, this is important stuff, especially if you're a fan of, having a functioning global economy. Think of an LG as a safety net in the high-stakes game of international trade. It's essentially a promise made by a bank saying, hey, if this one company doesn't hold up their end of the deal, we'll step in and cover the costs. This reassurance allows businesses to take risks, secure deals, and keep those cargo ships a-sailing. Without LGs, international trade would be a whole lot messier. Imagine trying to buy 1,000 rubber chickens from a supplier in another country without any guarantee they'll actually deliver the goods. You'd be constantly worried about getting ripped off, and nobody wants to live in a world where you can't trust in the power of mass-produced poultry-themed toys. So, there you have it, a crash course on letters of guarantee. Stick around as we delve deeper into the nitty-gritty of these financial superheroes. Now let's meet the key players in the LG drama. We've got ourselves a classic three-way dynamic here, folks, each with their own role to play. First up, we've got the guarantor. This is usually a bank, because let's face it, who else has pockets deep enough to back up these promises? The guarantor is the one saying, "Don't worry, I got your back." Next, we have the beneficiary. This is the party who benefits from the guarantee, usually the one receiving the goods or services. They're the ones breathing a sigh of relief, knowing that someone's got their back if things go south. Last but not least, we have the principal. This is the party whose performance is being guaranteed. They're the ones who need to fulfill the terms of the contract, whether it's delivering those rubber chickens on time or building a bridge that doesn't spontaneously combust. So there you have it, the three amigos of the LG world. Each one plays a crucial role in making sure that international trade goes as smoothly as a well-oiled rubber chicken. Now let's talk about how these LGs actually get issued. It's not as simple as signing your name on a napkin and hoping for the best, although wouldn't that be nice? There are three main ways to issue an LG1 wet signature. This is the old school method, think physical documents, ink signatures, and probably a few paper cuts for good measure. It's like sending a raven with a message, but instead of a raven, it's a courier with a briefcase handcuffed to their wrist. Too SWIFT. This stands for Society for Worldwide Interbank Financial Telecommunication. Catchy, right? It's basically a super secure messaging system that banks use to zip these guarantees around the globe electronically. Think of it as email, but with a lot less spam and a lot more financial security. 3, counter guarantee. This is where things get a little meta. It's basically a guarantee for a guarantee. Imagine you're buying a used car from a guy who got it from another guy who swears it's in perfect condition. You might ask your friend to vouch for the seller, and then your friend's mum might vouch for your friend, just to be extra safe. That's kind of what a counter guarantee is like. So there you have it, the three main ways to issue an LG. Each method has its own pros and cons, but they all serve the same purpose: to provide that sweet, sweet peace of mind in the often unpredictable world of international trade. Let's start with the OG of LG issuance, the wet signature. Picture this. A mahogany desk, a green banker's lamp casting a warm glow, and a fountain pen poised over a crisp document. It's all very official, very traditional, and very inefficient. With a wet signature, the issuing bank drafts up the LG, signs it with actual pen and ink, and then sends the original document to the beneficiary. This usually involves couriers, international shipping, and a whole lot of waiting around. It's like sending a postcard in the age of instant messaging. But hey, some people prefer the personal touch, right? And there's something to be said for the weight of a physical document. Plus, it gives everyone involved a chance to practice their calligraphy skills. Who doesn't love a good Spencerian script? However, the downsides are pretty obvious. It's slow, it's costly, and there's always the risk of the document getting lost, damaged, or eaten by a rogue office dog. And nobody wants to explain to a client that their million-dollar deal is on hold because Sparky mistook their LG for a chew toy. So while the wet signature method might have a certain old-world charm, it's slowly being replaced by faster, more secure methods. But hey, maybe it'll make a comeback someday, like vinyl records and high-waisted jeans. Section 5 SWIFT guarantees at the speed of light. Now let's talk about SWIFT, the superhero of LG issuance. This system is all about speed, security, and efficiency. It's like sending a text message, but instead of emojis, you're sending legally binding financial guarantees. With SWIFT, the issuing bank creates an electronic message containing all the details of the LG. This message is then sent through the SWIFT network, which is like a super secure digital highway connecting banks all over the world. The beneficiary's bank receives the message, verifies its authenticity, and voila, the guarantee is in effect. No more waiting around for couriers, no more risking lost documents, and no more worrying about paper cuts. It's fast, it's secure, and it's about as close to instant gratification as you can get in the world of international finance. SWIFT has become the go-to method for issuing LGs, and for good reason. It's simply the most efficient and reliable way to get the job done. Plus, it saves a lot of trees, and who doesn't love trees? Section 6, Counter Guarantees, guaranteeing the guarantee. Now, let's talk about counter guarantees, the LG equivalent of wearing suspenders and a belt. It's basically a guarantee for a guarantee, providing an extra layer of security in situations where the beneficiary wants to be extra cautious. Think of it like this. You're about to bungee jump for the first time. You trust the bungee jumping company, but you're still a little nervous, so you ask your best friend to stand on the bridge with a really big net, just in case. That's kind of what a counter guarantee is like. In this scenario, the issuing bank provides a guarantee to the beneficiary's bank. Then, the beneficiary's bank asks another bank, usually in the principal's country, to issue a counter guarantee. This means that if the issuing bank fails to honor the original guarantee, the counter-guaranteeing bank will step in and cover the costs. It's like having a backup plan for your backup plan. Sure, it might seem a little excessive, but when you're dealing with large sums of money and international transactions, a little extra caution never hurts. Plus, it gives everyone involved a warm, fuzzy feeling of security. Section 7. The many flavors of guarantees, a guide to LG types. Now that we've covered the basics of LG issuance, let's talk about the different types of guarantees out there. It's like a buffet of financial instruments, each one designed to address a specific need. Here's a quick rundown of some of the most common types of LGs: tender guarantee or bid bond. This guarantees that if a contractor wins a bid for a project, they'll actually sign the contract and put down a performance guarantee. It's like a financial pinky swear, ensuring that everyone's serious about this whole construction project thing. Performance guarantee. This guarantees that a contractor will complete a project according to the agreed upon terms. It's like having a financial safety net in case the contractor decides to skip town with the deposit money and a half-finished treehouse. Advance payment guarantee. This guarantees that if a buyer makes an advance payment, the seller will actually deliver the goods or services. It's like having a financial insurance policy against shady sellers who vanish into thin air with your hard-earned cash. Payment guarantee. This guarantees that a buyer will pay for goods or services once they've been delivered. It's like having a financial guarantee that your clients won't suddenly develop amnesia and forget all about that invoice you sent them. Financial guarantee. This is a broad category of guarantees that covers various financial obligations such as loan repayments and bond issuances. It's like having a financial safety net for all sorts of financial transactions, ensuring that everyone gets their money when they're supposed to. Warranty guarantee. This guarantees that a product will function as promised for a specific period. It's like having a financial backup plan in case your brand new smartphone spontaneously combusts or your self-driving car decides to take a detour to the moon. Retention guarantee. This guarantees that a contractor will fix any defects that arise after a project is completed. It's like having a financial insurance policy against shoddy workmanship and ensures that your new bathroom renovation won't turn into a plumbing nightmare. So there you have it, a crash course in the wonderful world of LG types. It's like a financial buffet, and there's a guarantee out there for every taste and occasion. Section 8, Guarantees in Action, Real-World Examples. Let's bring this whole LG thing to life with some real-world examples, because, let's face it, abstract financial instruments are about as exciting as watching paint dry, even with my dazzling commentary. Example 1, the case of the delayed rubber chickens. Imagine a toy company in the United States wants to import 10,000 rubber chickens from a supplier in China. They need those chickens to arrive by a certain date to meet holiday demand. but they're a bit wary of wiring a large sum of money overseas without any guarantees. Enter the LG. The toy company asks their bank to issue a payment guarantee to the Chinese supplier. This guarantee assures the supplier that they'll receive their payment upon delivery of the rubber chickens. Now, the toy company can rest assured that they won't be left high and dry with a warehouse full of unsold rubber chickens. And the supplier can confidently ship the goods knowing they'll get paid. It's a win-win for everyone involved, except maybe for the chickens. Example 2, the bridge over troubled waters. Let's say a construction company wins a bid to build a bridge in a foreign country. The government awarding the contract wants to ensure the company will actually finish the job, and the construction company wants to secure payment for their work. This is where a performance guarantee comes in handy. The construction company's bank issues a guarantee to the government, promising that the bridge will be built according to the specifications and on time. If the construction company fails to deliver, the government can call on the guarantee and receive compensation. This way, the government gets its bridge, and the construction company gets paid. And hopefully the bridge doesn't collapse, because that would make for a very awkward phone call to the bank. Example 3, the warranty of the wonky widget. Imagine a tech company launches a new gadget, let's call it the wonky widget. They want to assure customers that their product is top-notch and will function properly. So they offer a 1-year warranty backed by a warranty guarantee. If the wonky widget malfunctions within that year, the customer can return it for a repair or replacement, and the guarantee ensures that the tech company will cover the costs. This gives customers peace of mind and boosts their confidence in the product. And hopefully the wonky widget actually works as advertised, because nobody wants to deal with a flood of warranty claims. These are just a few examples of how LGs play a crucial role in facilitating international trade. They provide a safety net for businesses, encourage investment, and help keep the global economy humming along. Section 9 LGs, the unsung heroes of global commerce. So there you have it, folks, a whirlwind tour of the fascinating world of letters of guarantee. They might not be as glamorous as a Wall Street ticker tape parade or as exciting as a hostile takeover, but these unassuming documents play a vital role in the global economy. LGs are the unsung heroes of international trade, providing a safety net for businesses, facilitating transactions, and promoting trust between parties separated by oceans and continents. They're the oil that keeps the gears of global commerce turning smoothly. So the next time you hear the term letter of guarantee, don't let your eyes glaze over. Remember, behind those seemingly boring words lies a world of financial security, international trade, and yes, even a few rubber chickens. And that, my friends, is something worth talking about. That's our show for tonight. See you next time when we'll be exploring the thrilling world of... Actually, I don't know yet, but I'm sure it'll be just as riveting as this. Good night.